Good afternoon, everybody. Uneducated economist here. So I was just reading through some of the news articles, and yeah, it's not a surprise to see that there is going to be a bunch of layoffs inside of the mortgage market. Whoever it is that participates as far as employment in the mortgage market should be quite worried coming into the future because the refinancing of mortgages most likely is not going to be happening. I mean, I guess there could be some people who are looking to take the equity out of their homes that might refinance, but the refinancing because of the lower interest rates to try and get a better deal, that's over. That's not going to be happening again for quite some time. And so you just don't need as many people working. Now, this was one of the schemes, this rolling over of old debt into new debt was one of the ways that they were able to keep the mortgage servicers in operation. Now, a lot of people don't really kind of follow how a mortgage works, but when you take out a mortgage, there's an in-between middleman called a mortgage servicer who is promising to make sure that your payment goes on to the investors of the mortgage-backed securities. So there's a servicer out there who is guaranteeing your payment to be made, whether you make it or not. And those servicers had to continue, those mortgage servicing operations had to continue during the pandemic when everybody was told that they didn't have to make their payments anymore. There was a forbearance taking place, right? So this was going to cause the mortgage servicers to go under. Now, we've talked about this in the past, and that the Federal Reserve must have a functioning mortgage market in order for their monetary policy to be operational, or to have a good functioning monetary policy. They have to have a good functioning mortgage market. I guess that's probably the better way of saying it. So these mortgage servicers, they were going to go under, but they had so many people refinancing their old debt into new debt with the lower interest rate that they were able to continue to do operations and be able to get funding for their company. So this is where the mortgage servicers were actually benefited or kept in existence by having the lower interest rates and getting people to roll their debts over into new debts. Well, this time is over. So now it's not a matter of rolling debts over into new debts. It's a matter of selling brand new mortgages to people. That is going to slow down dramatically with the rising of interest rates. Now, I could only assume that at some point we are going to start seeing some inventory rising. Once we start seeing the inventories rising, we're going to start seeing more mortgages rolling over or new mortgages being issued. So this got me thinking about, like, okay, so what's going to happen with the Federal Reserve and the investors of mortgage-backed securities, because there's less mortgage-backed securities being produced, right? When you had massive refinancing taking place, when somebody refinanced their loan, that was basically taking out the old loan and reestablishing a brand new one. Well, when that happened, that basically pays off the mortgage-backed security and a new one is reestablished. This is where the Federal Reserve constantly was purchasing mortgage-backed securities, because there was this constantly rolling over of old debt into new debt. Well, that's coming to an end, and the Federal Reserve is backing away from their mortgage-backed security purchases. So the investors who are out there that are not the Fed, that still want to invest in the mortgage-backed securities, there's less of them coming onto market. At the same time, the Federal Reserve is also purchasing less. You kind of see where I'm getting at here? And so this is going to have that impact on the market, unlike what people were thinking as far as the Federal Reserve backing away or, even unwinding their balance sheet. Is that if there's less mortgages being made in order to produce those mortgage-backed securities, that will give the Federal Reserve the room in order to sell off or just unwind some of those mortgage-backed securities that are on their balance sheet. Anyway, you can see it happening in that article that I leave down in the description on that one. So this is something to to kind of follow. Like, it's not so much like, because a lot of people are looking at the Federal Reserve alone. Like, they say, okay, the Federal Reserve and the unwinding of their balance sheet is going to cause this to happen. But it's not just that. There's other issues inside of it, and that's where, like, following what's going on with the layoffs, that's very telling. There's less mortgages being issued, therefore there's less people needed. There's going to be less mortgage-backed securities, and now the Federal Reserve has their room. You kind of see where I'm getting at on that. Anyway, what else did I want to add to this one? I guess that was it. I'll just make it a short one. Uneducated economist. You guys let me know.